Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I'm going to teach you how to invest in stocks for beginners step by step. So this video is basically going to be a course or a mini course in and of itself. So I highly recommend that you watch it from beginning to end. Whether you're a beginner or even an intermediate trader or a stock investor, you're going to find nuggets of information all throughout this video. If you're not a fan of this kind of setup, or if you like the whiteboard better, the reason I'm doing it this way is because this is going to be a PowerPoint presentation mixed with live trading, mixed with me actually handwriting some stuff on this tablet here. So that's an easier way to teach you, just that way you can see it live and it'll be easier to connect the dots. So let's get right into it. So this presentation here I created. Obviously it's presented by me, and if you don't know who I am, here's some quick credibility points on me. I've been investing in the stock market for 15 years now. I started when I was 18 years old. I'm 33 at the time of this recording, which is pretty crazy how time flies. But I started with a TradeKing account. So TradeKing was acquired by Ally, and I've actually advanced to Vanguard, TD Ameritrade, M1 Finance, Robinhood, Webull. There's a million different brokerages that I have my money on. The reason for that is because I actually review brokerages for both my blog and also for this channel. So I like to have my money in a lot of different places. I actually have a finance degree and an entrepreneurship degree as well. I graduated in December of 2010, literally 10 years ago to the date, which is pretty crazy, starting to feel old. And I've actually worked in finance and commercial real estate a majority of my career. So I worked at a publicly traded bank as a credit analyst, so basically doing what I do with this stock information or these balance sheets and ratios that I'm going to teach you about. I actually did that as a job. So KeyBank is a publicly traded bank. Worked at Marcus & Millichap on the commercial lending side. They're a publicly traded real estate advisory services firm. And then I also worked for a real estate developer for many years. I've built homes. That's actually a duplex that I built from the ground up. And I've done a lot of stuff in real estate. And then finally, I've been providing free value on YouTube since November of 2017. At the time of this recording, I think I have somewhere around 465,000 subscribers. So just some housekeeping before we get started. We're going to get into the presentation, but there's a lot of value in this slide, so please pay attention. I'm going to make this presentation downloadable after I upload it and have a link, and then that way you can actually download this entire PowerPoint presentation. That way you can keep it, share it, do whatever you want with it. There are some offers with free stocks using the links below at the time of this recording. Robinhood, which is the broker that I will be giving you examples on of actually buying and selling a stock on there. They're actually giving out a free stock. Webull is, and then M1 Finance as well. I also do have a free training available in the description below for M1 Finance. And then finally, Whiteboard Finance University, that's going to be my university, which is essentially going to take you from Finance 101, being somewhat financially illiterate, all the way to Finance 401, which is basically a master's degree in finance, if you will. So complete financial literacy, understanding how to master your money and build your wealth over time. So with that being said, let's get right into it. So why should you invest in the stock market? So it's clearly been one of the best tools to grow wealth over time throughout human history. The market has averaged roughly a 10% annual return on investment historically. The second point is savers are losers. This is to battle inflation. So everyone knows that having assets is better than just sitting on cash, especially in the interest rate environment that we're living in. But if you're a beginner to the stock market or the economy, this may be a little bit over your head. Just understand that you are losing purchasing power by not investing. It's never been cheaper to invest. These are $0 trades. Those are the norm. $0 fees is the norm. I remember when I started, the only reason I went with TradeKing is because they had super cheap trades. I think it was like $4.95 a trade, and this was 15 years ago. So now it's pretty much free everywhere. Also, there's low expense ratios for solid investments with index funds and ETFs through Vanguard and other brokerages, which we're going to talk about later in the video. And then finally, you don't have to be a genius. There are strategies that help you grow your wealth over time, which I will talk about in this video. So let's get right into it. I'm going to give you a little preliminary background, a little bit of an analytical background, and then we're going to go exactly into the live demo of buying our first stock, okay? But before we do that, we don't want to put the cart before the horse. What is a stock exactly? So a stock is simply a share of ownership in a company. So think of each share being a slice slice of pizza, okay? So when we're buying shares, this gives you equity, aka ownership shares in a company. So let's take an example. We have Microsoft, okay, which everyone is familiar with. They have shares outstanding of 7.56 billion. So if you think of a pizza or a pie, think of a pie divided into 7.56 billion slices. This is essentially what their shares outstanding are. So their share price, just for easy numbers, I did create this presentation a few days before I actually recorded it. So some of these numbers may not be exactly accurate, but I will be showing you a live demo on how to figure out all this stuff. So their share price at the time of this presentation was $216.02. So you need to understand what market cap is. So market capitalization is simply the shares outstanding, that's 7.56 billion. Multiplied by the share price, okay? So let me give you a quick example of that. Okay, so just so you can visualize this, let's pretend that we have a pizza here, and the pizza has 4 slices. So we have slice 1, 2, 3, 4. Okay, it's almost like a pie, not a pizza. Pretend that this is a company. Let's just say that this is Microsoft, okay? These 4 shares that you see here are each worth, let's say, $1,000. $1,000 times 4 shares. Answering down in the comments below if you know the answer. I'll give you a second here. Well, that's simple math. That just tells us that this company's market cap is $4,000. So going back to market cap, that is simply the number of shares outstanding multiplied by the share price. So if each share is worth $1,000 and you have 4 shares of this company, their market cap is $4,000. So let's go back into the presentation here. So now that we understand market cap, you just simply take that 7.56 billion multiplied by the share price of Microsoft, which is $216.02. Maybe easier if I have a pointer here. And then you simply get a market cap of $1.633 trillion, okay? This is important because companies are typically measured by their market cap, okay? So market cap changes over time because share prices and shares outstanding can change over time. That's like saying, hey, XYZ company went up in price, XYZ company went down in price. That's obviously changing their market cap as time goes on. So why do companies issue stocks? Well, this is simply to raise money for their business. Think of it like this. They are giving out shares of their pie, their equity, that's why stocks are called equities, in order to receive money from the general public in an IPO, an initial public offering. That's basically like crowdfunding for their business, if you will. So this could be used to fund a new product line. It could be used for R&D and research and development. It could be used to invest in the growth of their company. A lot of companies themselves were doing stock buybacks, which is actually reducing the number of shares outstanding. And then you also have paying off debt, okay? So there is a difference between preferred stock and common stock. So preferred stock is that you have no voting rights. Common stock, you do have voting rights. However, you are the last in line to get paid out in case of a liquidation. So if a company goes bankrupt and they have to sell everything that they own, they may be going bankrupt and you may not get paid out. That's a rough reality of being a common shareholder. And then also, you are the last to get paid a dividend. And then when you're thinking of buying a stock, or if you're a complete newbie and you're saying like, hey, I'm just buying stocks, you are typically buying common shares when you hear that analogy or hear that statement. So how are stocks categorized? This is important. So we have large cap, mid cap, and small cap stocks. So if you remember, we talked about market cap in this example down here with the different shares outstanding. That's pretty much how you capitalize a company, okay? So market cap, again, is just shares outstanding by the share price. So large cap companies are typically 10 billion plus, okay? These are typically hard to achieve massive growth due to their size. So think of a huge, well-established company, right? These could be your Johnson & Johnsons or your Pfizers or these companies that have been around for years. They've pretty much reached their peak, and now they are a huge, large cap company. They have proven track records over many years, and they frequently offer dividends. That's because they want to offer the dividend back to their shareholders as kind of a thank you for being a shareholder in the company. The easiest analogy to make with that is picture you're a landlord and you have a single family home. The price of the property can go up or down, just like the share price can go up or down, but the tenants in the property are paying you rent every month. That's kind of what a dividend is. Then you have mid-cap stocks, which are 2 billion to 10 billion in market cap. They're not quite large cap. They're not quite there yet. but they also have a more established track record than the small cap stocks. They are also often the target of M&A, okay? So if you're not familiar with what M&A is, that simply stands for mergers and acquisitions. These are bigger fish that are eating up the smaller fish, either for their staff or their technology or making an exit because the owner just wants to get paid. Then you have small cap stocks, which are $300 million to $2 billion in market cap. These are typically younger and are seeking aggressive growth, and they are typically higher risk and don't usually offer dividends. This is because they are so early on in their journey as a company of going public. They may have a proven track record up until IPO or up until going public, but they may not pan out. There's a lot of these tech companies that happen even today that this happens to. So if we want to visualize this, you can take a look at this classic box by Morningstar. I'm sure you've seen this either in your 401k or in your fund at work. You know, this box is like your typical classic categorization of different types of stocks. Obviously, this isn't, 100%, granular, but it gives you an idea of how these things are broken up. So if you look at the x-axis, which is on the bottom, you can see value, blend, and growth. We'll talk about those in a minute here. And then if you look at the y-axis on the right, you can see large, mid, and small cap. So you can have a combination of all these things, right? However, companies typically gravitate towards one end of the spectrum or the other, and sometimes you have some outliers, but this is a good way to think about it when you're looking at different companies to invest in. So how are these stocks categorized? Continued. We have growth stocks, we have income stocks, and we have value stocks. So growth stocks have big potential for growth. So these are typically companies that are outpacing the market, such as Amazon, Facebook, Microsoft. They typically offer low or no dividends, however, because they're reinvesting their retained earnings into the things that we talked about. This could be things like research and development. It could be things like paying off debt. It could be things like trying to improve their product or their service line or advertising or marketing. Then we have income stocks. So these are stocks that pay a regular dividend payment or a regular income payment. So think of 3M, think of Walmart, think of Verizon, think of utilities companies. Okay, these are companies that have been around a long time and have the ability on their balance sheet to pay a dividend. So they typically have a proven track record or business model, and they have consistent increases in dividends over time. If you want to learn more about my own dividend portfolio, you can click on that link once you download this presentation, and the presentation download link will be in the description below. And then finally, we have value stocks. So value stocks are perceived to be trading below their fundamentals. So think of something that's on sale or that's cheap. Typically, as value investors, we look at price to earnings ratio or price to book ratio. And all these ratios we're going to talk about later in the video. And then typically these are seen as unfavorable in the marketplace. That's why they are undervalued. So think of, the puppy that no one wants to take home at the shelter, but it could end up being like, the greatest dog in the world or the greatest companion in the world. That's kind of like my cheesy analogy to value stocks, right? A lot of people see the fleas and they see, the disease and the worms and things like that on the dog, and they don't want to take it home. But once it gets cleaned up and the value is brought out, it could end up being your best friend. So continuing on how stocks are categorized, we have stock sectors. Okay, so there are 11 broad-based sectors. These are areas of the economy in which businesses share a product or a service. So we have energy. This could be your oil, gas, coal, fuel, things like that. We have materials, which are chemicals, metals, paper. Industrials, which is your defense, your aerospace, your manufacturing. So think of like Boeing or Lockheed Martin, for example. You have consumer discretionary. This could be apparel, household products, things like that. Consumer staples. These are your food, your beverages. Healthcare, which is big pharma. Healthcare equipment like Medtronic, for example. Financials are typically banks. So think of like KeyBank, M&T Bank, Wells Fargo, all these big publicly traded banks. Number 8 is IT, which is internet, software, semiconductors. This is a sector that has grown a lot over the past 10 years. So think of your, Teslas, your Microsofts, your Apples, etc. And then number 9 is telecommunication services, AT&T and Verizon, for example. You have utilities, so these are the big electric companies, gas companies, water companies. And then you have number 11, which is real estate, which could be REITs. These are real estate investment trusts, such as apartments, malls, office space. We'll talk about all this later in the presentation. So now that we're understanding how stocks are categorized, we need to understand risk. Risk is the whole point of investing. This is how we're compensated as investors. We're compensated for the amount of risk that we take on. So what is risk? Risk is the chance that your actual outcome will differ from your expected outcome. So if I'm little Jimmy and I'm starting to invest in stocks, right, and I think that Tesla is going to go to 20,000 a share, right, and it ends up not doing that, that is the risk that I'm taking by going into that position. So risk includes the chance of losing some or all of your investment. So contrary to popular belief and contrary memes, especially at the time of this recording, stocks don't always go up, okay? There's times when stocks do go down, and that is risk, and that's what you're being compensated for. So risk, as mentioned here, should be your reward. As investors, we're compensated for the level of risk we assume. So for example, if I want to invest in a startup versus a savings account, I need to be compensated significantly higher for the amount of risk that I'm taking on for investing in a startup company, which has no proven, model or track record, versus just putting my cash in a savings account, for example, which is FDIC insured and a much safer, quote unquote, investment. So there are different types of risk, okay? There's a million different definitions and a million different types, but these 7 I've highlighted because I've come across them many times throughout my career and also through my education. So number 1 is market risk. This is basically the market as a whole. So if you look at economic developments or other events over time, this could pose a risk to your portfolio. If you remember 2008, some of you do, some of you don't, 2008 was huge systemic risk. It was huge market risk that crushed everyone's portfolio in almost every product type all across the board. Of course, I'm generalizing, but I'm just trying to prove a point here with market risk. Number 2 is liquidity risk. So this is the fact that, hey, I can't sell this investment. It's not liquid. Say you own a huge warehouse in the middle of nowhere, in the middle of a cornfield, for example. That warehouse may produce an income and may be worth something intrinsically, but what if you want to go sell that warehouse? How many buyers do want to buy a warehouse in the middle of a cornfield? That comes down to liquidity risk. Can you sell this asset quickly? Number 3 is concentration risk. You have too many eggs in one basket, meaning that you have way too many stocks that are similar, or you have all your money just in one stock, that kind of a thing. This is your capital is concentrated so much that it's become a risk, meaning that you have too many eggs in one basket. Number 4 is credit risk. This means that the entity can't repay. So the company that you're investing in, for example, they can't pay off their credit, and which causes them to liquidate certain things or causes them to go out of business. Okay, this also applies in bonds, which I'm not going to get into in this video. You have inflation risk, which is the loss of purchasing power. I alluded to this earlier in the video. If you've been following my channel for a while now, I've been making multiple savers or losers videos over time. This is basically talking about if inflation becomes too low or if inflation becomes too high, you are literally losing purchasing power, okay? So say, for example, you have 3%, you're making 3% in a savings account online, which is laughable at the time of this recording. I'm just using this for an example. And then the cost of everything else is going up 5%. You're actually losing 2% a year in purchasing power, okay? So think about that. Number 6 is horizon risk. This is your investment time frame if it changes over time, okay? So say, for example, you were originally planning on getting into an investment and being in it for 10 years. However, you got sick and you have no other money, so you had to sell part of that investment after only a year because you needed to fund your medical bills, for example. That's just a quick example that people can relate to. So your time horizon, if it changes, time horizon is a risk. If you think it's going to take 10 years for an investment to pan out or 1 year for an investment to pan out, and that changes, again, that is horizon risk. Number 7 is foreign investment risk. So this applies to foreign investments. So say, for example, I want to invest in, the hottest new startup in North Korea, for example, and that startup just gets crushed or whatever, or just gets put out of business instantly by the government for whatever reason. That is the foreign investment risk that I'm taking on by investing into that area or that country. Okay, so moving on, what are the types of stocks or equities, or what are we even buying here? So number 1 is individual stocks. So when you think of individual stocks, this goes back to common shares or common stock that I talked about. So when you're saying, hey, I'm buying a share of Tesla, I'm buying a share of Microsoft, I'm buying a share of Apple, These are individual stocks, okay? Number 2 is mutual funds. I'm not going to explain that here because I'm going to go into each one of these in detail. Number 3 is index funds. Number 4 are exchange traded funds, or ETFs. I'm sure you've heard of that acronym, especially if you've watched my channel. And then finally, you have REITs, which are real estate investment trusts. So individual stocks, this is, as I mentioned, these are your Walmarts, your Netflixes, your Exxon Mobils, et cetera, et cetera. These are individual companies or individual shares in individual companies. Some of the pros are that they have reduced or no fees to buy or maintain these. There's no management fee to own them, meaning you're not paying a professional manager to buy or sell these shares, and you're also not paying anyone to actually manage this investment for you. You are the owner of these shares. You have complete control and understanding, hopefully, of what you own because you're researching, you're doing your due diligence, you're watching this video and sharing it with a friend, and you're understanding completely what you're doing when you invest in these companies. And then finally, the last pro is that taxes are pretty easy to manage. I'm going to talk about this in the last slide, but you have capital gains and capital losses. The cons to owning stocks are that they're hard to diversify. So if you're investing in one individual company, you're exposing yourself to concentration risk, as we talked about. So you're going to need 20 to 100 different shares of stocks, not shares, excuse me, different companies to achieve adequate diversification. This takes more effort or time to monitor your portfolio because you're always looking at rebalancing, which we'll talk about. And then you're also doing your due diligence. You're reading 10Ks, you're reading, different financial reports, which we'll talk about in this video as well. You're doing all this stuff, burning the midnight oil, trying to find that one gem that seems to be underpriced or undervalued or is a value stock, which we talked about. So this takes a lot of time and effort. And then finally, FOMO and emotions. So FOMO stands for fear of missing out. So when you're in the rec center locker room and all these guys are saying, oh man, I bought Tesla when it was $100, now it's $1 million. You start to get that FOMO and you want to buy in at $1 million because everyone else bought in and is making money, right? So let's go into mutual funds. So mutual funds are simply pools of money from the public to buy securities or assets or equities. So the pros of this is that they're extremely liquid. They don't have that liquidity risk when we talked about that warehouse in the middle of a cornfield. These are very easy to buy and sell and partake in. They're very diverse because they invest in a lot of different things typically. Most mutual funds typically have professional management, whether this is active, meaning that there's an actual portfolio manager or a human being and a team of human beings managing this, versus passive, which we'll talk about in the next slide. There's a lot of options. You have balanced mutual funds, you have fixed income, you have money markets, you have income producing mutual funds. So there's a lot to choose from. Some of the cons are that these have higher fees, especially if they're actively managed. Most mutual funds are not FDIC insured, meaning that if you're familiar with going to your bank and having your savings account insured up to $200,000 or $250,000 at the time of this recording, mutual funds don't offer that coverage or that benefit, okay? Then finally, they have large cash holdings, which means that they have to keep a lot of their money in cash, which we all know at the time of this recording, savers are losers and cash is trash. If you don't understand that, I suggest you sign up for my school. It'll all become more clear, or watch the videos that I've done on that. And then finally, it's hard to evaluate, to make an apples to apples comparison from one mutual fund to the next. Okay, so moving on with index funds, this is a basket of stocks to mimic a certain market index. So if you're familiar with the S&P 500 or the NASDAQ, for example, these are all indices that are able to be tracked by index funds. Some of the pros are that they have low fees, actually extremely low fees, especially if it's passively managed. The studies have shown that these have typically outperformed active management over time, which is pretty crazy to think about, which actually makes them extremely easy to own, manage, invest in, and achieve your goals over time. Some of the cons are that you don't have any of the control over the holdings. You're not picking individual stocks. You're basically just accepting what that manager or that passive fund is giving you. You have a lack of downside protection, meaning that if stocks take a plunge, this isn't a hedge fund, meaning you're not hedged to help prevent any downside, okay? So if you looked at ETFs or index funds after 2008, they got hit almost just as hard as individual stocks. And then they lack different strategies, okay, which we'll get into later. So moving on to ETFs. ETFs are simply a basket of stocks, again, to mimic a certain market sector that trade on an exchange. So some of the pros to this is that you have access to many stocks. So if you think of an ETF, think of one share, just like you would buy one share in Apple, for example, except that one share contains hundreds, if not thousands, of different companies or stocks weighted up to 100%. So one share is buying you a basket of stocks with an ETF. So they have extremely low expense ratios, again, because they're either passively or actively managed, which actually passes the savings on down to you. If you don't, I should have clarified, if you don't know what an expense ratio is, it is simply a percentage or an annual fee to pay whatever fund you're using. So if I'm using a Vanguard ETF, I'm paying them an expense ratio of, let's say, 0.05%, okay? So 5 basis points, meaning 5 fractions of a percent, if you will. So they're easy to own, they're easy to manage, and they're easy to invest in. And they're easy to achieve your goals with, just like index funds. However, some of the actively managed ETFs have higher fees. They also have a lack of downside protection because it's not a hedge fund again. And then diversification is limited by focusing simply on one industry, if that is the case. So to round this out, we have REITs, which again are real estate investment trusts. This is a company that owns, operates, or finances income-producing real estate. So the pros of this is that you actually have access to a historically inaccessible asset class. This used to be for the rich people, bourgeoisie, super wealthy, peasants that were middle class and lower class. What business do we have investing in commercial real estate, right? Well, REITs have actually allowed these companies to go public and make them very liquid, and actually give the masses access to their balance sheets, if you will. So you get stable cash flow through dividends because REITs have to pay out 90% of the income they produce. And historically, commercial real estate has been a sound asset class. I worked in commercial real estate for many years. It's definitely a wealthy person's game, at least on the physical side. But again, with these REITs, you are partaking in actual physical real estate. Some of the cons are that the dividends are taxed as regular income. They're subject to market risk. So if you look at the economy downturn in 2008, a lot of commercial real estate got absolutely crushed. I know a lot of people personally that went bankrupt, a lot of people that drank themselves to death. But I'm not going to get into that, especially in this video. But it is what it is. Maybe in a smoke-filled room we can talk about that, but probably not. Because I ain't no snitch. So cons, you can have high management fees, okay? So with these come a lot of high management fees that sometimes these owner-operators may end up paying themselves. So let's talk about how to evaluate a company. So now that we know what to buy in, what a stock is, common shares, preferred shares, all that good stuff. Let's talk about how to actually evaluate these things. Are we sitting there like some random investor that's just kind of like picking stocks on a dartboard, blindfolded? Or are we someone that's actually doing our due diligence and actually breaking these things down and finding out what they're worth? So we're going to talk about how to evaluate a company right now. So there's financial ratios when buying stocks. I'm sure you've all heard of like PE ratio or price to book ratio or things like that. But where do these numbers come from? Okay, where are we actually coming up with these numbers? So they come from 3 different sheets or 3 different financial statements, excuse me. So you have your balance sheet, which is a snapshot of your financials. So think of someone taking a snapshot of a picture in time. This is defined as assets equal liabilities plus shareholders' equity. That is a picture of your balance sheet. Next, you have your income statement, which shows your revenues and expenses during a specific period. So you typically have your net income equals total revenue plus any gains that you have, minus your total expenses plus losses for that period. And then number 3 is a cash flow statement. This is talking about the cash inflow and the cash outflow of a business. So number 1 is operations. These are your business activities. Number 2 is investing. This could be PP&E, which is property, plant, and equipment, or CapEx, which is capital expenditures. And then number 3 is your financing. So you have cash flow between your business and your creditors, which is shown on a company's 10K. So let's dig into the 5 different financial ratios when buying stocks. Okay, so there's more, but it boils down to basically these five. You have valuation ratios, you have profitability ratios, you have liquidity ratios, you have debt ratios, which are talking about solvency, like how are you as a company financially, health-wise? Do you have the ability to pay your debts? And then number five is efficiency. So if we look at a price to earnings ratio, this is a PE ratio. I'm sure you've all heard of this if you've been investing for any amount of time. This is what we call a valuation ratio. A PE ratio is simply a company's share price to its earnings per share. So this is showing the relative value of a company's shares, apples to apples, okay? So the formula for this is market value per share divided by earnings per share. So let's take a look at a live example right now of Microsoft. Okay, so this is finviz.com. If you've never used Finviz before, it's a great website for visualizing value and analytics. They even have a nice little heat map right here so you can see exactly what the market is doing. Green being, gains, red being losses. However, that's besides the point. I've been using this since college, actually, which is crazy. It makes me feel old. But anyway, you can see here the chart of Microsoft. This right now is showing a candle chart, which is beyond the scope of this video because this gets into technical analysis. But basically, you can see that the chart is from April to December. And you can change the time frame. You can change it to weekly, monthly. But this isn't really what Finviz is designed for. What it's designed for is to give you quick, easy metrics and a way to actually select criteria. That way you can invest in stocks that you're interested in based on your criteria. So remember, if we go back to our definition of PE ratio, it is simply the market value per share divided by earnings per share. So these numbers aren't 100% up to date, so they may be off just a little bit, but it's important for you to see how this is calculated. So if I'm looking at Microsoft right now in Robinhood, I can see that the price of one share is $225.56. So if I go back to Finviz, I can see that their earnings per share right here for the last 12 months, that's what TTM stands for, trailing 12 months, is 6.2, okay? So if I want to figure this out, I would simply go to this calculator. I would type in the share price, remember our formula, it's price per share divided by earnings per share, which is 6.2. So if I go back to the calculator, put in 6.2, we should get something close to 35. So we get 36.38, okay? So you know how I know that? Because the PE ratio, the answer is right here. It's 35.94. So we aren't necessarily wrong. It's just that these are using, outdated numbers to come up with this PE ratio. So our number is correct. We simply took the share price right here, divided by the earnings per share, giving us 36.38. So that is how we figure out price to earnings ratio. So if we go back to the presentation here, a healthy PE ratio typically, historically, and there's a lot of background to this comment, but basically historically before low interest rates, money printing, all that good stuff, a healthy PE ratio to value investors was typically 15 or lower. So we can see at a valuation of PE ratio of 36, Microsoft seems to be a little bit overpriced because that's what we're paying in terms of the price to its earnings per share. Okay, so the price of the stock divided by its earnings per share of that stock. That's what helps us get that apples to apples comparison. Okay, so the next ratio we're going to take a look at is the PEG ratio. The PEG ratio is simply a valuation metric that takes the company's share price to its earnings per share growth. Okay, so this gives us the relative value of a company's stock value factoring in growth. So if we look at the formula should be the price divided by the earnings per share, which we know both those things. We just calculated that for PE ratio, divided by earnings per share growth. So the earnings per share growth is an estimate. So if you take a look at Finviz right here, we typically use the next 5 years for the long-term annual growth estimate that analysts predict. And we can see here that it's 14.55. So if I want to show you guys how to do this, let me write this down. So remember that our formula is simply the share price. So let's just use 225.50 for easy numbers, divided by the earnings per share. Remember, this was 6.2 in our last example, and I'll show you right here again. You can basically see in the top right, earnings per share is 6.2. And then we're going to have the earnings per share growth, which was 14.55%. So this should get us a number close. If you take a look at the PEG ratio, the answer is right here, 2.47. If we put this all into the calculator right here, we can use 225.5 divided by 6.2. That gives us 36.37, which was our PE ratio, divided by 14.55. That gives us 2.49. So we were close enough. Remember, these numbers are not updated, so we're going to look wrong even though we're not. So that's PEG ratio. That was pretty simple, you guys. So moving forward, I'm going to give you some more ratios. I'm not going to go through each one, but I will show you the answers on FinViz, and that way we can actually glean some information on Microsoft using this. So the next one is the price to book ratio. This is also a valuation ratio. The price to book ratio is a company's market cap to its book value. So this compares the cost of a stock to the value of its equity if the company was sold today. So this is basically the stock to assets value. So the formula for this is the market price per share divided by book value per share. Book value is simply total assets minus total liabilities divided by shares outstanding. And we're shooting for a healthy PB ratio of 3 or lower. Okay, so if I go to FinViz, we can see here that the PB ratio is 13.66. So this basically means that the stock is trading 13.6 times what Microsoft's total assets are, if that makes sense, or the book value of its assets. So that's really, really high. Okay, so the next metric is return on assets. Return on assets is a profitability ratio. Return on assets basically shows you how profitable a company is compared to its assets. So it gives an investor an idea as to how efficient a company's management is basically running the assets to generate earnings. It basically says like, hey, you know, what have you done for me based on what I've given you? Did I give you lemons? Did you make lemonade? That kind of a thing. So the formula is net income divided by total assets. And I'll give you a live example here. I'm not going to do the math, but I'll show you on FinViz. You can see right in the middle of the screen in the middle column, the ROA is 16.2%, which is very good. The other thing I like about FinViz is it kind of highlights the green and the red, meaning that if the ratio is black, it's kind of neutral. If it's green, it's good. If it's red, it's bad. So if we go back to this, you can see here at the bottom, I made a note that a healthy ROA ratio or a healthy ROA is 5% or higher. And if we look at this, we can see that Microsoft is 16.2%. The reason I have an asterisk after all these healthy ratios is because this is all subjective. These ratios are completely dependent on the type of company, the type of business. Is it a small cap, medium cap, large cap? Is it a high-flying tech stock? Is it a conservative income or value stock? That's why this is all subjective. Typically, these numbers come from value investing historically, but you can see here that it's all subjective. So the next ratio is return on equity. This is another profitability ratio. Return on equity is simply a measure of how efficient a company is at generating profits. So this gives an investor an idea as to the profitability of a company in relation to its stockholders' equity. So the formula here is simply net income divided by total assets. So if we look at this, you can see that Microsoft's ROE is 40.7%, which is crazy high. A healthy ROE ratio is subjective by industry, as I just mentioned, but we can see here that to me is very, very good. This says that the income that they're producing divided by their assets is very high. Okay, so the next ratio is the current ratio. This is a liquidity ratio, meaning that how easy can this company take their assets and liquidate them to pay off or satisfy debt or payables. So the current ratio measures the ability to pay short-term obligations or those due within 1 year, and this basically gives an investor an idea how a company can maximize those current assets on its balance sheet, as I just mentioned, to satisfy debt and payables. So the formula for this is current assets divided by current liabilities. So if we take a look at Microsoft, you can see that their quick ratio is right around 2.5. So 2.5 is okay. What you're typically looking for is anywhere from like just over 1 to about 2, that means that you have the ability to liquidate very quickly and that your current assets are greater than your current liabilities. So if we look at the quick ratio, this is another liquidity ratio, which gives a measure of a company's capacity to pay its current liabilities without needing to sell inventory or get more financing. This is obviously considered more conservative because this is taking into account, if you look at the formula here, cash plus marketable securities plus accounts receivable divided by those current liabilities. So if we go back to Microsoft, their quick ratio is 2.5 as well. Ideal is somewhere 1 to 1, which basically means that you have just as much cash as you do liabilities, meaning that going back to the theme of kind of like cash is trash, you're not just sitting on a bunch of cash being deteriorated by purchasing power going down. It's basically just a 1 to 1 ratio at that point, and you're utilizing your funds appropriately. So if we go to debt to equity, this is a debt to solvency or debt/solvency ratio. Basically, this is a measure of a company's financial leverage. So a measure of the degree that a company is financing its operations through debt versus wholly owned funds. This basically means that you can do this for your own personal finances if you want. It's basically taking your total liabilities divided by total shareholders' equity. So I'll give you an example right now. So if we look at this formula right here, debt to equity is basically a ratio that measures that company's financial leverage. So you take the debt that you have divided by the equity. So if we take a look at these two companies, we have company 1, which has a debt to equity ratio of 5 because they have $100,000 in business loans and they only have $20,000 in retained earnings. And company 2, they have a 0.5 debt to equity ratio, meaning that they have $50,000 in business loans in this example, divided by $100,000 of retained earnings. This means that they are a low-risk company and a better investment. So the next ratio is an efficiency ratio. This is asset turnover. So asset turnover ratio is basically the measure of a company's ability to use its assets to generate sales or revenue. So what this tells us is the degree that a company is financing its operations through debt versus wholly owned funds, meaning its own assets. So the formula makes sense. So take a look at this. It's total sales divided by the beginning assets plus the ending assets divided by 2. The denominator is divided by 2. I'll show you that here. So if you take a look at these companies, you have 4 publicly traded companies: Walmart, Target, AT&T, and Verizon. If you look at the y-axis on the left, you have beginning assets, ending assets, average total assets, their revenue, and then their asset turnover ratio. So you can see that Walmart is 2.3, Target is 1.79, AT&T is 0.41, and Verizon is 0.52. So if you go back to this slide, again, this is showing us the measure of a company's ability to use its asset to generate sales and revenue. So a healthy PB ratio, or excuse me, asset turnover ratio, that's a typo down there on the bottom, the higher number is preferable. So we can see here that Amazon is utilizing their assets in order to create more sales, if that makes sense. Okay, the moment you've all been waiting for, and some of you probably skipped to this section. You probably skipped the analysis, you skipped the ratios. You're like, that stuff's boring. I want to buy stocks, baby. Stocks only go up. Let's get rich, right? Well, stocks do go down, as we talked about in the risk section. However, I'm going to be buying a stock right now together. So we're going to be using Robinhood. And if you download this presentation or click on the link below and actually sign up for Robinhood, you get a free stock at the time of this recording. So this is not a sponsored video or anything like that. I actually have my money in Robinhood as one of my brokerage accounts. However, the reason I'm choosing Robinhood is because if you truly are a beginner, and from a beginner standpoint, it is one of the easiest ways to get a full grasp of what's actually going on, which we're going to go into live right now. So this is my Robinhood account. You can see here that right now I have $29,500 worth of equities and cash, a combination of both. Keep in mind, this is one of my many brokerages. I use this to basically learn more about Robinhood myself, and that way I can provide, critiques, I can provide criticism, I can provide, pros and cons, that kind of a thing in the reviews that I do. So let's continue the theme of using Microsoft. So this is an individual stock. Remember, we talked about stocks, ETFs, things like that. We are kind of getting close to the end of the trading day here at the time of this recording, so I'm going to try and squeeze this in very quickly. So this is a chart, okay? This is not the most technical chart in the world, but basically you can see here that if I choose to expand this, I can get into something a little bit more technical, but that's not the point of this video. I'm actually going to use this just to kind of prove my point here. So right now we're looking at a one-day chart of Microsoft. So this means that anything that's going on from the beginning of trading, which is Monday through Friday, 9 a.m. Eastern Standard Time, all the way to the end of the day, which we're not at yet, just yet. It's 3:48 at the time of this recording. So you can see that it went up and down, but it stayed somewhere right around, let's call it $225 per share, as we've been using in our example. So you can actually zoom out. You can go to a 1-week chart. You can go to a 1-month chart. You can go to a 3-month chart. You can go to a 1-year chart or a 5-year chart. Most charts or most brokerages will actually let you go to all time, meaning that from when the company IPO'd, which was the initial public offering, all the way until current time. So if you can see here, in the past 5 years, if you invested in Robinhood, you would be up a whopping 306%, okay? So that means that you basically started January 1st, 2016, when it was valued at $55.48 per share. 5 years later, you basically went up to $169 per share, which gets you at $225 per share, which is a crazy return. Now imagine if you did this over many years, compounding on the dividends that Microsoft offers. So what we're going to show you here is how to actually buy a stock. So if you look at the top right corner up here, you have buy and sell, and it gives you the ticker symbol of MSFT. So if I go to buy Microsoft, I can either invest a dollar amount or a shares amount. So there's different schools of thoughts on this. Now with fractional shares, you can actually invest any amount of money, and it'll let you buy a fraction of this $225.18, or this fraction of the share price. That is called fractional shares. So to give you an example, if I wanted to buy 1 share of Microsoft, it would cost me this right here, $225.13. So how do we arrive at this price? How does this price even come into existence? Well, let me explain here. Remember that this is a market, okay? We have a bid and an ask. So if you click on the question mark here or click on market price, this will open up this window right here. You can see what the last sale of Microsoft was. It was at $225.14. There's always going to be a bid and there's always going to be an ask. The bid is what bidders are willing to pay for Microsoft or 1 share of Microsoft. The ask is what people are asking for, the sellers of it. So remember, buyer, seller. It's a marketplace. You have to come somewhere in the middle and come to an agreement, okay? So people can unload their shares for less or for more, but you may or may not have buyers, and at that point, the market isn't efficient. So, but that's a topic for a whole another, video or course, if you will. But if I wanted to buy, let's call it 1.5 shares, you can see here that my estimated cost is going to go up. The cool thing is that you can go out to a bunch of different decimal places as long as it lets you buy it. I wouldn't recommend going out too far. However, if you wanted to do a dollar amount, it makes it much easier. Say, for example, you're a beginner and you're just getting started and you deposited, let's say, $100, right? And you wanted to buy that $100 worth of Microsoft. Well, at this point, it'll let you go out to 1, 2, 3, 4, 5, 6 decimal places and actually allow you to buy 0.444207, for example, shares of Microsoft. So in this example, let's do a dollar trade just because I don't feel like buying a whole share of Microsoft. Let's buy $50 worth of Microsoft. So if I click on review order, the nice thing about Robinhood is that they're actually going to explain to you exactly what's happening. So it's saying that you are placing a good for day market order, which I'll explain in a second here, to buy $50 of Microsoft based on the current market price of $225.05. You'll receive approximately X amount of shares. Your order will be executed at the best price available. Now, this is what we call a market order, okay? So if I wanted to edit this, actually, let's just do this. Let me buy $50. That way I can explain this, and we'll end this note here. So I'm going to click buy, and it's going to ask me to put in my password and a bunch of stuff, which I'll do right now. Okay, so I just put in my password, and you can see here the amount I invested was $50. I purchased 0.222034 shares at an average price per share at $225.19. Okay, so we can see here if I compare my average share price, $225.19, to the current share price of Microsoft, I'm actually down whatever that is in cents, multiplied by 0.222. So without this getting any more confusing, the cool thing about Robinhood is that if I actually go to buy this in shares, let's say I click on, I want to buy 1 share. You can then review this order. However, what I recommend doing is clicking this little caret right up here and changing the order. You can change it to a limit order or either a recurring order. Since this video is for beginners, I don't recommend playing with stop loss or stop limit or trailing stop. That's a different conversation for a different day. However, the difference between these orders, I'll explain right now. So when I bought that $50 worth of Microsoft, that was a market order. I basically said, hey, whatever the market price is or whatever the shares are of this stock, I want it to fill right away and I want it to execute right away. I don't care if it's, $225 or $235, for example. That is a market order. These are going to be executed almost right away as long as there is a buyer and a seller, okay? What I recommend for newbies or for people that, have a certain dollar amount in mind is a limit order. So what a limit order is basically putting in a price. You can see here there's a limit price. I know that it's trading for $225, but say that I know that there's going to be some, bad news or there's going to be, something that drives the price down, and I don't want to buy it right now at $225.13. I want to buy it when it goes to $224.30, for example. So if I put this order in, I can pick how many shares I want. Let's just pick 1 share, for example, and I'm going to make this good for the day, okay? So up until the end of trading today, this will basically execute. You can change this until canceled. So this order, it'll give you 90 days to expire, but either way, it will not strike. This will not happen until my limit price is reached, okay? So since I don't want to buy another share of Microsoft at this price, let's just make this a ridiculous number just for example, for this video. We're at $198. It's definitely not going to reach that by the end of the day today. I can guarantee you that. So we can either do good for end of the day or good till canceled. Let's do good for the end of the day. You can also check to allow this order to execute during extended hours, which means anytime after 4:30 p.m. That's the trading time, Eastern Standard Time, but we don't care about that. So now I'm going to hit review order, and this will explain to you, you are placing a good for day limit order to buy 1 share of Microsoft. The order is pending, meaning that it's not going to execute until it reaches your limit, which is 198. So if you're a beginner, the whole reason I'm telling you all this is because if you are if you don't want to get into a certain stock right away, or if you want to get into it at a lower price, or if you want to hedge the market price, meaning that, hey, say it's at $224.97, but it jumps up to $227 for whatever reason, at least you know you're going to get the stock at your limit price. This is almost buying at a guaranteed amount as long as there is a buyer and a seller. Make sense? Okay, so now that we've actually bought Microsoft, let's teach you how to sell. So selling is very simple. It's the same exact process. Remember, you have a market order or a limit order. These stop losses and stop limits and trailing stops, they actually become very handy. But again, that's outside the scope of this video. So if I want to do a market order, that means that I'm going to sell my Microsoft at whatever the market price is. Right now it's showing that it's $225.04. If I'm not happy with that, what would I do? That's a quiz to my audience. If you're still with me at this point, I know it's a long video, but it's important. I would set up a limit order. So I know that, hey, I know that I want to get rid of my Microsoft shares for $227 a share, and I'm going to sell, I don't know, let's call it 5 shares. Actually, I don't own 5 shares. Let's just use one. I actually own a couple here. I have you can see down here, I have 2.38 shares available of Microsoft. So if I wanted to do this, I can set it up for good till day or good till canceled. This gives it basically 90 days. And I can also allow this to execute during extended hours. Since I don't want to do that, I'm going to sell Microsoft at a market order. And it's going to be in dollars. I'm just going to sell $50 worth. Remember, that's the amount that we basically bought. I bought at a higher price than this, so I'm going to take a very small loss. I'm going to take an L for the audience. So hopefully you're with me here, but I'm going to click review order and sell. Okay, so since the market is actually closed at the time of this recording, it won't let me sell, and I don't want to get into after hours by selling a whole share. That is basically the process. So I know that was very anticlimactic, but you guys get the idea based on the buy order. So those are the two different ways with market orders and limit orders to buy stocks. What I would recommend, again, if you're a beginner, all you do is click on the caret, do a limit order, figure out the price you want to pay, multiply it by the shares that you want. And then you can set it for good for day or good for canceled. If you want to do a market order, you can do the same thing in dollars or in shares, and that's how much stock you will actually buy. Okay, so now let's get into the rest of the presentation. So there are ramifications and taxable events when you do buy and sell stocks. So we tried to sell that Microsoft stock, but we took a big L in terms of presentation quality. We weren't actually able to do it because it was 4 p.m. over here. But basically, there are two different things that happen when you buy and sell stocks. So you can buy and sell a stock for a gain. You can buy and sell a stock for a loss. So number one here is explaining a capital gain. So a capital gain is simply when you sold for greater than what you bought it for. So say you bought it for $100, you sold it for $110. That is a capital gain of $10. Let's take a look at a capital loss. This is simply the same thing, just in reverse. You sold it for less than what you bought it for. You took a loss. So say, for example, you bought Microsoft worth $110, you sold it for $100. This is a capital loss of $10. So what happens here is with a short-term capital gain or loss, means that you did this within 1 year. You did it within a 1-year time frame. So you held that Microsoft stock, you bought it and sold it within 1 calendar year. This counts as regular taxable income. So your tax brackets can be anywhere depending on your income, but that is the percentage you will pay on that capital gain, okay? Same thing with a long-term capital gain or loss. This is the same thing as the short-term capital gain, except that you held this equity or you made this transaction longer than 1 year. You held it for longer than 1 year. So with this being said, with a capital gain, this is taxed differently and typically more favorably depending on your income tax bracket. It could be anywhere from 0, 15, or 25%, dependent on your filing status and your income. So that pretty much concludes the entire presentation. I just wanted to give you a quick reminder about the free gifts and the added value in this video. So now that we know how to kind of analyze stocks, we know how to look at some metrics, some ratios, how to read the balance sheet, cash flow, income statement, things like that. I know I didn't go into super depth, but it actually helps you if you are a beginner to actually learn those things early on and build a strong foundation. So very quickly, again, if you want to download this presentation, you can do that in the link in the description below. It'll also probably be in the pinned comment, the first comment of the video. There's free stocks if you sign up for Robinhood, Webull, and then M1 Finance. There's a free training available also in the description below. That's my free training. It's a private link to a YouTube video. And then also, if you want to get courses that are going to be higher quality than this one, this is just an intro, you guys. Please make sure to join the waiting list for Whiteboard Finance University. This is my school. It's going to be packed with courses, weekly live streams, Q&A with myself, talking about anything and everything. We're going to be talking about literally macroeconomics, crypto, Bitcoin, stocks, like literally anything that's on your mind. And we're also going to have a community Discord, so you can get that community chat involved as well. And courses will be updated as well throughout the lifetime of the group. So that's pretty much all I got for you guys. Thank you so much for sitting through this. This took a lot of work to outline and record, but hopefully you watched the whole video. Please send it to one friend or a family member or post it on your WhatsApp investing groups or Facebook groups. All this stuff is free, and it's all about providing free knowledge. Thank you so much, everybody. Hit the like button and have a prosperous day.